Welcome to Unfiltered Finance. If you're tired of the financial illusions and ready for the brutal math, you are in exactly the right place. Let's dive in. Yesterday, the global financial markets witnessed a triumph not just of capital, but of human engineering. The most anticipated initial public offering in modern history didn't just meet expectations, it shattered them, opening to a staggering institutional trading volume. SpaceX stock surged 23.58% above its reference price. The bell rang, and the stock closed the day at an astonishing $166.7 per share. Welcome back to Unfiltered Finance. Today, we are analyzing an absolute masterclass in corporate valuation. Elon Musk's aerospace empire didn't just execute a successful IPO, it minted a public valuation north of $210 billion. To put that in perspective, this single entity is now dwarfing legacy defense and aerospace competitors that have existed for nearly a century. We are witnessing the birth of the first true mega-cap space monopoly, commanding multiples that defy traditional financial physics. But to truly understand the sheer gravity of this epic financial milestone, we have to rewind the clock. We have to go back to a dusty, ruined launch pad on a remote island in late 2008. After 3 consecutive catastrophic rocket explosions, Musk was down to his last $20 million. He was staring directly into the absolute abyss of corporate bankruptcy, forced to choose between saving Tesla or his space dream. Most analysts at the time wrote the company off as a billionaire's failed, eccentric vanity project. Yet, from that complete darkness to yesterday's $210 billion public triumph, they pulled off the impossible. How did they mathematically justify this valuation? And more importantly, what does it mean for your portfolio? Let's dive in. To justify a $210 billion market cap, you have to fundamentally break an industry's entire economic model. For 60 years, the legacy aerospace sector operated on a fatally flawed and wasteful premise: expendability. Imagine boarding a massive $200 million commercial airliner for a flight from New York to London. And upon landing, instead of refueling it, you throw the entire airplane straight into the ocean. As absurd as that sounds, that was the exact business model of the global space industry. Legacy players, the giant joint ventures of the old military-industrial complex, were comfortably charging the United States government upwards of $400 million per single launch. Their bloated profit margins were deeply protected by decades of political lobbying in Washington and a bureaucratic cost-plus contracting model that actually incentivized them to be slow and expensive. It was a lazy monopoly, built entirely on political inertia rather than engineering efficiency or innovation. Then, the paradigm shifted forever. Enter the reusable booster, a machine that would rewrite physics, a sleek, violently efficient machine designed from the ground up to do what was considered totally impossible. By engineering a rocket that could deliver its payload, and instead of burning up in the atmosphere, autonomously turn around and fly itself back to Earth, landing precisely on a robotic drone ship. By simply washing it off and flying it again, they utterly decimated the marginal cost of accessing space. Let's dive deeper into the brutal, unforgiving math of orbital mechanics and unit economics. In the aerospace industry, the ultimate metric is incredibly simple: the cost to deliver 1 kilogram of payload to low Earth orbit. During the legacy space shuttle era, that cost was a staggering $60,000 for a single kilogram. Imagine paying the price of a brand new luxury sports car just to put a single bottle of water into space. Legacy expendable rockets from Boeing and European competitors eventually brought that number down, but they hit an absolute technological and economic wall at around $10,000 per kilogram. Then came the reusable Falcon 9, tearing through that wall like a hypersonic sledgehammer. By autonomously landing and flying the exact same boosters repeatedly, it crushed the cost down to roughly $2,600 per kilogram. But the company isn't stopping there. The upcoming Starship program represents an entirely new economic paradigm. Made of cheap stainless steel and fully reusable, Starship aims for an unbelievable $10 to $50 per kilogram. This is not just an incremental technological update. It is a violent structural collapse of the cost curve. In traditional corporate finance, when a new entrant reduces the primary cost of goods sold by 95%, In an industry characterized by massive, seemingly insurmountable barriers to entry, they don't just take market share from the old guard, they become the entire market, holding an absolute, unrivaled monopoly over human access to the stars. But make no mistake, Wall Street isn't paying $166.7 a share just for rockets. The launch business, as mechanically impressive as it is, has a hard financial ceiling. There are only so many government satellites and scientific probes the world needs to launch. In reality, the rockets are just delivery trucks. The true financial engine, the undisputed cash cow that built this historic IPO, is their global satellite internet constellation. This constellation isn't just a space exploration project, it's a fully integrated telecommunications utility. Legacy telecom companies spend hundreds of billions of dollars painfully digging trenches for fiber optic cables, and their physical reach is strictly limited by geography, mountains, and vast oceans. But by aggressively launching thousands of proprietary satellites using their own discounted, reusable rockets, the company entirely bypassed the old terrestrial infrastructure. They went straight to space. They vertically integrated the internet itself, beaming high-speed data directly to the most remote users. Strategically, this creates an unparalleled monopoly. You are no longer competing with local cable providers. You become the sole owner of a broadband infrastructure that covers the entire planet Earth. Every single dish sold is a terminal directly connecting a consumer's wallet to the company's balance sheet. And that staggering cash generation engine is exactly what ignited the $210 billion Wall Street frenzy. To understand this massive valuation, let's open the financial ledger and look at the absolute numbers. Back in 2022, building this global network was a massive capital expenditure black hole. Starlink was bleeding billions of dollars in capex just to manufacture and launch the initial constellation. Many traditional Wall Street analysts scoffed, predicting that the heavy debt load would crush the operation. But by 2024, the fundamental math of the space business completely and violently flipped. With over 3 million active subscribers worldwide, the network reached a critical mass of adoption. With each user paying roughly $120 a month for their physical internet terminals, the revenue stream transformed into a massive, unstoppable river of recurring subscription income. Starlink officially crossed the Rubicon into free cash flow positive territory. It began generating an estimated $2 billion in pure operating cash flow for SpaceX. For institutional investors, this exact financial transition is considered the holy grail of corporate finance. A brutally capital-intensive infrastructure project that survives its initial cash-burning build-out phase, achieves critical global scale, and suddenly transitions into a high-margin, highly profitable business model. It starts behaving exactly like a recurring revenue software as a service, or SaaS, tech company. Wall Street absolutely loves SaaS valuation multiples, and Starlink is the ultimate physical SaaS monopoly. So if the company is already printing billions in cash, why on earth did they decide to go public now? Elon Musk famously stated he wouldn't IPO SpaceX until regular flights to Mars were underway. But the harsh reality of corporate finance boils down to two things. Liquidity, early institutional heavyweights, who poured $1 billion into the company back in 2015, have been locked up without any public exit liquidity for nearly a decade. The IPO finally creates a liquid, publicly traded currency to financially reward thousands of loyal engineers. And secondly, funding the next monumental phase of the Starship program requires an astronomical amount of capital. We are talking about sovereign-scale capital, money on the level of a small nation's GDP. That kind of liquidity can only be provided by the global public equity markets. A public listing turns the company's equity into a highly liquid, incredibly powerful currency. This currency allows them to raise cheap debt and fund massive acquisitions without burning cash. All of this capital is structured to fund the ultimate multi-trillion-dollar ambition, a permanent, self-sustaining civilization, and a multi-planetary logistics network. For a dream that massive, the $210 billion IPO wasn't just an option, it was inevitable. Now, let's put on our analyst hats. How do we rationally price a $210 billion space company? Valuation is fundamentally a game of comparisons. You weigh entities against their historical peers. If we treat them like a traditional defense contractor, Say, Lockheed Martin or Northrop Grumman, they typically trade at a sluggish 2 to 3 times their annual top-line revenue and around 12 to 15 times their enterprise value to EBITDA. If we estimate that SpaceX generated roughly $10 billion in revenue last year, a legacy defense multiple would mathematically value them at roughly $30 billion. $30 billion. But yesterday, the public equity market confidently priced them at $210 billion. That is a staggering 700% premium over the traditional industry standard. Clearly, the public equity market is completely ignoring legacy aerospace valuation models. Wall Street has looked at the old defense contractor rulebook and thrown it directly into the fire. They realize that pricing this entity as a mere hardware manufacturer is fundamentally incorrect. You cannot mathematically price an absolute monopoly using the multiples of highly competitive, slow-moving dinosaurs. This isn't just a disruptive aerospace firm. It is an entirely new financial asset class. To genuinely understand the $210 billion, we have to look to the software monopolies of Silicon Valley. Instead of valuing them like an aging aircraft manufacturer, Wall Street is treating them like an AI-era software monopoly. The stock is currently trading at over 20 times its trailing 12-month revenue. You only see price-to-sales multiples that astronomical in hyper-growth tech titans like NVIDIA or Microsoft. So how does a company that bends heavy industrial steel command the financial multiples of pure digital code? Because the market isn't just pricing the physical hardware of the rockets or the individual satellites. They are pricing a permanent, inescapable tax on the entire future orbital economy. If humanity is going to build data centers in orbit, or mine asteroids, or colonize Mars, every single kilogram of that infrastructure has to be carried on the back of this company's rockets. Even the United States Department of Defense has found itself completely dependent on this single private entity, with legacy competitors suffering years of delays, safety scandals, and catastrophic cost overruns. There is practically no viable alternative for reliable, heavy-lift access to space. In finance, when you hold the exclusive keys to a critical global choke point, you dictate the price. This is the ultimate tech monopoly premium. You aren't just buying a balance sheet, you are buying the exclusive toll road that connects Earth to the rest of the solar system. And that is precisely why a $210 billion price tag is considered, by some, just the beginning. To truly grasp the sheer magnitude of yesterday's $166.07 per share close, we must take a hard, unforgiving look at the old aerospace guard. As of this IPO, SpaceX is worth more than Boeing, Lockheed Martin, and Northrop Grumman combined. We are witnessing a historic, violent transfer of market capitalization and shareholder wealth. Look at Boeing, drowning in over $40 billion of corporate debt, and plagued by endless, deeply concerning safety and engineering scandals, they have seen their market equity value completely and utterly hollowed out. There is an absolute, unavoidable law in finance. Capital aggressively flows to efficiency, and right now, the most brutally efficient engineering machine on the planet is SpaceX. Institutional money is entirely ruthless. It completely abandons stagnation and violently chases innovation. By comfortably pricing this single new entity at over $210 billion, the global public market has effectively declared the old aerospace bureaucratic model dead. The luxurious era of being constantly rewarded with guaranteed profits for being slow and expensive is entirely over. Even the Pentagon is forcing the old guard to either adapt instantly or die. We are witnessing the ultimate victory of capital allocation. Wealth transferring from the bureaucrats to the builders. When a $210 billion behemoth enters the public markets, it doesn't just quietly float onto the stock exchange. It creates an absolute, unstoppable macroeconomic liquidity tsunami. Passive index funds, defense ETFs, and massive institutional portfolios, like those managed by BlackRock and Vanguard, are mathematically forced to rebalance. Their algorithms operate without emotion, strictly following market capitalization weightings. If you run a large-cap growth fund, you literally have no choice. You must aggressively buy this newly listed stock simply to track your own benchmark and avoid underperforming the market. But the total pool of capital in the global financial ecosystem is finite. Every dollar that flows into this new $210 billion giant must be mechanically sucked out of another asset. This means capital is being violently drained from legacy defense stocks, and even other mega-cap tech equities are feeling the brutal vacuum effect. as portfolio managers liquidate their old, stagnant positions to make room for the new king. But with this astronomical $210 billion valuation comes extreme, unprecedented concentration risk. Because SpaceX is no longer just a private commercial enterprise building cool tech. It has evolved into a highly critical, completely irreplaceable arm of United States national security. From exclusively launching highly classified Department of Defense payloads into orbit, to keeping vital internet infrastructure alive and operational in active global war zones. Their geopolitical moat is absolute. Right now, no other Western entity can replace them. However, this absolute dominance also means their revenue stream is inextricably tethered directly to the political whims, budgets, and red tape of the Pentagon and NASA. Furthermore, their rapid testing methodology is entirely at the mercy of regulatory bodies. If political or diplomatic relations suddenly sour, or if administrators decide to ground their fleet, the entire multi-billion-dollar cash-generating machine can be legally forced to a complete halt. Because of this, the stock's beta, its statistical measure of market volatility, will be incredibly high. Investors must be prepared for violent, multi-billion-dollar price swings based purely on a single government press release. It is the ultimate double-edged sword of doing business at a sovereign, planetary scale. You have a total monopoly, yes, but your single biggest customer also holds the ultimate power to destroy you. But the absolute elephant in the room, the single greatest existential risk to this $210 billion valuation, is the next-generation launch vehicle, Starship. It is the largest, most complex flying machine ever conceived. While the Starlink constellation is currently throwing off massive, highly profitable amounts of free cash flow, the Starship Research and Development Program is effectively a giant incinerator, violently burning through that cash. We are looking at pure capital expenditures on a scale previously reserved only for sovereign nations. If Starship experiences prolonged, catastrophic engineering failures during its testing phase, or if the entire program gets brutally bogged down in multi-year regulatory reviews by the FAA, the entire free cash flow narrative that Wall Street loves so much will violently collapse. You see, the current $166.7 share price does not leave absolutely any room for error. It fundamentally assumes that Starship will work flawlessly, and do so on an aggressively tight timeline. It assumes they will successfully reduce the cost of orbital access by yet another massive order of magnitude. In pure financial terms, this stock is flawlessly priced for absolute, unmitigated perfection. There is effectively zero margin of safety built into a 20 times revenue multiple. If the founder's ultimate multiplanetary gamble falters, the brutal gravity of traditional finance will pull this valuation down. It is a high-wire act of historic proportions, balancing human destiny against Wall Street's patience. So, is there any viable threat to this $210 billion orbital monopoly? Enter Jeff Bezos and Blue Origin. Backed by the virtually unlimited cash flow of Amazon, he is pouring billions of his personal e-commerce fortune into catching up to SpaceX. But despite the unlimited capital, they remain years behind in orbital and reusability data. SpaceX possesses a data moat built on thousands of real-world flight hours that money simply cannot buy. The real existential threat doesn't come from another tech billionaire. It comes from sovereign nations. Specifically, China's national space program, which is rapidly reverse engineering and iterating on reusable rocket designs. This isn't just a corporate market share battle. It is the Cold War space race reborn for the 21st century. But here is the critical catch for you, the Western public market investor. If you want to allocate capital to the space economy in the public markets, there is absolutely no one else you can buy. Blue Origin is private. The Chinese program is state-owned. It creates a classic TINA market. There is no alternative. Institutional capital is effectively trapped. If they want space exposure, they must pay the $210 billion toll. And retail investors, driven completely by FOMO, are blindly piling in alongside them. Until a viable public rival emerges, this monopoly premium will remain wildly inflated. So, we return to the ultimate question. Is SpaceX, at $166.7 a share, overvalued? If you ask Benjamin Graham, or any strict traditional value investor, running a classic discounted cash flow model, the required growth rate to justify this multiple is mathematically terrifying. Yes, it is overvalued, but the modern market is no longer strictly bound by classical arithmetic. In a world where absolute monopolies dictate absolute pricing power, and where this single entity holds the only functional keys to the broadband internet infrastructure of the entire developing world, and the absolute critical military launch infrastructure of the developed world, it naturally commands a massive, mathematically immeasurable scarcity premium. When you pay $166.7 a share, you aren't just buying a standard corporate balance sheet, you are buying a highly leveraged, exclusive call option on the total commercialization and industrialization of the entire solar system. You are fundamentally betting that the human race will not remain permanently confined to a single planet. And yesterday, Wall Street collectively decided that this option is worth every single penny. 16 years ago, an exhausted founder sat in a ruined, dusty hangar on a remote island, with only $20 million left to his name, and a completely impossible dream. A dream that was quite literally hanging by a single, fraying thread. Yesterday, the public equity markets enthusiastically validated that desperate struggle to the staggering, world-changing tune of $210 billion. This historic IPO represents significantly more than just a massive corporate liquidity event. It represents a fundamental shift in how human civilization finances the seemingly impossible. The systemic risks are astronomical, and the valuation multiples are aggressively sky-high. But the economic moat is deep enough to hold an entire ocean. Welcome to the new era of orbital capitalism. This video is for informational and educational purposes only. It is not financial advice. All investing carries a risk of loss. The valuations and metrics discussed are estimates and subject to extreme market volatility. Always do your own thorough research and consult a licensed financial advisor before making any investment decisions. Thank you for watching. If you value the brutal truth over financial illusions, then hit subscribe today. To see how this math applies to your next move, click the video on your screen. I will see you there.